Okay, guys, today, welcome to chapter 3 on adjusting the account for the accounting principle based on the 9 editions uh, on a copyright owned by John Wiley, the Wiley Plus, 2022, John Wiley and Son Canada. The author of this presentation is Weigand, Kiso, Kimmel, Tenholm, Warren, and Novak. It's 9 Canadian editions. So we're gonna our learning objective of chapter 3 here to number 1 to explain accrual basis accounting when we recognize the revenue and expenses, and then number 2 describe the adjusting entry and prepare adjusting entry for prepayment. Number 3 prepare adjusting entry for accruals. Number 4 describe the nature and purpose of an adjusted trial balance and prepare one. And then the learning objective number 1 is to explain the accrual basis accounting when we to recognize revenue and expenses. Okay. Now, the adjusting account, there's a timing issue, which means that we are selecting an accounting certain time period. There's an accrual versus cash-based accounting. There's a revenue and expense recognitions. In terms of basic of adjusting entry, there are types of adjusting entries. There's prepayments and accrual, and adjusted trial balance and financial statement. Time periods. In the economic life of a business can be divided into time periods, generally in terms of month, a quarter, or either year, and permitted by periodicity of a concept. Period for 1 year, it is called fiscal year. Period of less than 1 year are called interim periods. In terms of reporting, it's different. So for example, the common base is January to December. Some company using from July to June. Some company started from August to July. So it depends. But the most common one here in North America is from January to December. Accrual versus cash-based accounting. In the accrual basis, events are recorded in the period when they occur, not when the cash is paid or received. In accordance with the GAAP, generally accepted accounting principle. That is an accrual basis. However, the cash basis is recorded based when revenue is recorded when cash is received, and expenses recorded when cash is paid. So cash basis is not in accordance to GAAP. So revenue recognitions. Revenue is recognized when there is an increase of an asset or decreased liability as a result of business activity with the customers. Revenue recognition principle provide guidance, and there's two processes in revenue recognition to determine when the performance obligation is complete and how much revenue is recognized. There's a contract base used by all companies that follow IFRS, which is International Financial Reporting Standard, and or the earning approach, which used by the company that follow ASPE. Under both IFRS and SPP, the revenue recognition principle follow the accrual basis principle. What is the contract base? Companies that follow IFRS use a 5-step contract-based approach to revenue recognition. When I was with Intech doing business consulting, when I was with Travels Canada, we are doing an IFRS 17 project, which is basically a revenue recognition of the revenue of the insurance as well as the expenses. So this is the project that I was involved for 3 years. There's a lot of things that get involved because you have to integrate all the system technology into a IFRS platform reporting system. So the revenue is recognized when the performance obligation is satisfied for service entity, often when the service provided, for entity that provides goods, often when the goods are transferred to the buyers. The amount that is recognized as revenue reflect the payment a business expect to receive in exchange for its goods and services. Okay. Contract-based approach, there's 5 steps in model revenue recognition. The first one is to identify the contract with the customer. Number 2 is to identify the performance obligation in the contract. Number 3 is to determine the transaction price. Number 4 is to allocate the transaction price to performance obligations. Number 5 is to recognize revenue and performance obligations are satisfied. Look at the terms of earnings approach. For companies that follow SPE, revenue is recognized when the post obligation is complete, the goods have been delivered to customer, the amount that will be recognized is known, there is no significant uncertainty about selling the price of the goods. Okay, the seller is confident that the amount due from the purchaser will be received. In terms of the expense recognitions, there's a matching concept often determines when to recognize the expenses. Accounting attempts to match costs and revenues. Expense recognition is tied to revenue recognitions. The long-lived asset expense are recognized over the life of the assets. Otherwise, expenses are reported in the period. That's basically conclude the objective number 1. On objective number 2, this is describing the adjusting entry and prepare adjusting entry for the prepayment. What are the accounting cycle? These are the accounting cycle. There's 1, 2, 3, 4, 5, 6, 7, 8, 9. There's 9 steps. Number 1 is analyze the transactions, journalize, and then do file posting, put it in trial balance, do an adjusting entry, doing adjusted trial balance, and then do prepare financial statement, and then prepare closing entry, and do a post-closing trial balance. So that's 9 steps. Okay. And then, what is the adjusting entry basics? It requires the preparation of financial statement. It needs to ensure that revenue is recorded when services are performed and goods are provided, and expenses are recorded as incurred. Make it possible to report asset, liabilities, and owner's equity. It is part of the accounting cycle. Every adjusting entry includes one income statement and one balance sheet account, classified as a prepayment and accrual. Adjusting entry prepayment, prepaid expense is expense paid in cash and recorded as asset before they are used or consumed. Okay. What is unearned revenues? Cash received recorded as a liability until services have been performed and revenue can be recognized. For example, I receive an order, let's say, of samosa from Bimo, 5,000 samosa. I have received the payment, but I have not delivered the product. That's a good example. Okay. Next one is prepaid expense. It is expired to the passage of time or as an asset is used up. Example of this will be like supplies, rent, and insurance. Okay. Prior adjustment assets are overstated or expense are understated. So in terms of adjusting entry, there's a debit here, an expense account to increase, and credit an asset account to decrease. Okay. The most common one is the rent or insurance. Prepaid insurance you usually pay for 1 year, or the rent you pay 1 year. It's the same kind of story. Okay. So what is the depreciation? Depreciation is the allocations of the cost long-lived assets to expense over their useful life. The portion of the asset that is used up or expired in each period and is reported as an expense. There's a straight line depreciation method. How you're going to calculate it? This is annual depreciation expense equal to cost divided by estimated useful life. For example, the cost is 120,000 and useful life 10 years, so we're going to be 12,000 a year. Okay, that's the straight line depreciation. Depreciation, in terms of adjusting entry, debit is depreciation expense to increase, and credit accumulated depreciation to increase. So basically, this is the typical adjusting entry. What are the contra account? Contra asset account is an account that opposite the balance of credit compared to its related asset account. It is deducted from its related asset account on the balance sheet. In terms of presentation, the accumulated depreciation account is deducted from the cost of asset on the balance sheet. The difference is called the carrying amount. So in terms of a good example here, October, November, December, you got an equivalent 5,000, 5,000, 5,000 here. Each year, let's say in October, depreciation $83, in November $160, December is $249. The carrying amount will be 4917 all the way for 834 and 4751. Unearned revenue. Cash received before the service are performed is recorded as liability, subsequently earned by performing a service or providing a good. Prior to adjustment, liability are overstated and revenue are understated. In terms of adjusting entry, liability account is debit, revenue account is credit. Example will be like rent, subscription, customer deposits. Okay, we're going to look at this example of the prepayment. Adjusting entry example here, prepaid expense like prepaid insurance. So this is the unadjusted balance, and on the debit side, the credit adjusting entry. When you put in a T count, it will go to debit to adjusting entry plus here. In terms of adjusting entry for liability and on revenue, debit adjusting entry here on the debit side, and then on the T count and credit side unadjusted balance. In terms of revenue, you're gonna do credit side here. So we're gonna look at the detail later in some of example of the exercise. Now we go into the learning objective number 3. Prepare adjusting objective number 3. Prepare the adjusting entry for the accrual. Required where items are not recorded in the accounts. Accrued revenues are revenue for service performed but not yet received in cash or recorded. Excuse me. Accrued expenses are expenses incurred but not yet paid in cash or recorded. Accrued revenues is accrued with passage of time or result from service performed but not billed or collected. Prior to adjustment, asset and revenues under understated. Adjusting entry is that asset and account is to be debit, credit will be revenue account. Example will be account receivable, rent receivable, or interest receivable. Accrued expense is example. Expense has incurred but not yet paid or recorded. Prior adjustment will be liability, expense, and the R will be understated. Okay. The adjusting entry for the accrued expense will be debit an expense to account, which is to increase, and then credit a liability accounts to increase. Example will be for this type of accrued expense in account payable, rent payable, salaries payable, and interest payable. We're gonna do into detail so you have an idea on how to make the adjustment. This is the logic first. The adjusting entry for accrued revenues, asset will be divided adjusting to plus it. For the revenue will be credit, adjusting entry will be plus increase one. In terms of accrued expense, the expense will be debit adjusting entry plus here, liability will be credit adjusting entry here on the T account side. Okay, so that's basically adjusting entry for the accrual. So we're gonna look at the learning objective number 4. Describe the nature, purpose of adjusted trial balance and prepared for one. Describe the nature, purpose of adjusted trial balance and prepared one. Okay, so what are the things? There's 7 steps. This is going to be adjusted trial balance and financial statement on this part. So what you're going to do that you're going to prepare after adjusting entry that have been journalized and posted, and proves that the total debit and credit balance are equal after all adjustments have been posted, and used to prepare a financial statement. An example of this will be, this is trial balance. Okay. You look at here the debit side, and the right side account receivable is 1200, supplies debit 1000, prepaid insurance 550. Then we have accumulated depreciation, credit is 83, and then revenue is 800 here, credit. Service payable 1600, and interest payable here 25. Service revenue is 11400, the red one, and then all depreciation here 83 adjustment, right? 83, 50 insurance expense. Okay. And then we have here salary expense, and then supplies expense, and then interest expense. So here interest expense, right? Debit and credit. You can see the adjustment there, adjusted trial balance. The key point is that all this debit and credit has to balance. All the debit is 30,658, the credit is 30,065. If it is not balanced, there's something wrong, and you have to go back and adjust. Look at piece by piece, one by one, where the entry is wrong. Okay. The next one is preparing income statement and statement of owner's equity. Income statement is prepared first from the revenue expense account. The statement of owner's equity is prepared next from the owner's equity and drawing accounts, and profit and loss from the income statement. Example will be here. We have to look at the adjusted trial balance, so we're gonna book it one by one, step by step. Here, service revenue 11,400, 11,400. Okay. And then we start with the expenses. Okay, first we're gonna put depreciation expense 50, depreciation 83 here, 83 here. Okay, and then insurance expense 50, and then rent expense 900 here, 900. Okay, this is coming from here, and then salaries expense, which is 5,600, coming from here. This are all the expenses here. This is all the expenses, and then supplies expense 1,500, and then interest expense 25. So you will see here all the revenues go all to the income statement. All the expenses also go to income statement. You will see tally up here. You got here 11,400 your revenue. Tally up your expenses 8158. Your profit will be 3242. So all the way you put it into your retained earnings, into the statement of honest equity, profit for the month 3242. That is the way you got it. Okay. After that, that's basically the preparing the income statement from adjusted trial balance, going into income statement, going to the honest equity. So where the investment coming from at 10,000 here, you can see 10,000 here. Okay, where you get the drawings coming from, the drawing is here 500. Okay, it shows you in the detail the graphic and the flow of funds. Okay, the trail of the funds, where it's supposed to go, where it's supposed to be the directions. Okay. Alright, so basically that's preparing the balance sheet. After that, you're going to prepare the balance sheet, asset and liability account, and the ending owner's capital balance from the statement of owner's equity. We're going to look at this. So once you've done the income statement, you're going to do the balance sheet from the adjusted trial balance. So you're going to put all the balance sheet portion, the asset side, cash 14,250, you got 14,250, account receivable you got 1,200, supplies you got 1,000, prepaid insurance you got 550, and equipment you got 5,000 minus 83, given the depreciations there, you got total asset 21,917. After you put the asset, then you're gonna start working on the liability side. The liability side start with the note payable 5,000, and then account payable 1,750. And revenue, which is 800, salaries payable 1,600, interest payable 25. You tally up, you got 9,175. Total liability, you tally up all the liabilities, you got 9,175. And from the previous slide, you got the honest equity 12,742. So total has to be balanced. Assets is equal to liability plus equity, so all the balance is 21,917. Okay, so this basically concludes this chapter. Again, this is a copyright owned by 2022 John Wiley and Son Canada. Thank you. This is chapter 3. Hope to see you soon. Alright guys, this basically conclude our videos, and hopefully to see you soon.